Welcome to Heart of Economy. What we're covering today isn't just politics. It touches the very core of global finance. Three leaders took the stage side by side in Tianjin: Xi Jinping, Vladimir Putin, and Narendra Modi. That image was a clear "we are here" message from countries representing a third of the world's population. And right after, Donald Trump fired back, "The US is India's biggest client, but they've imposed the highest tariffs on us. This has been a totally one-sided disaster." Now the key question: how does the picture translate to your investments, the strength of the dollar, energy prices, and the future of markets? In this video, we won't just recap what happened. We'll dig into how these developments could ripple through everything from equities to FX, from oil to bonds. If you're ready, let's begin. First, let's ask, why was the summit so important? Putin called it authentic multilateralism. Xi urged an end to a Cold War mentality. And after years away, Modi returned to the platform, signaling a visible rapprochement with Russia and China. These aren't just diplomatic flourishes. They point to which currencies will invoice trade, which regions will become new financial hubs, and which countries will control energy flows. History teaches us, in 1944, Bretton Woods made the dollar the world's reserve currency. In the 1970s, the petrodollar system linked energy trade to the dollar. And now, the message out of Tianjin suggests that order could gradually be shaken. Nobel laureate Joseph Stiglitz stresses the global economy no longer fits a unipolar framework. The rise of alternatives is inevitable. So this summit may be more than a photo op. It could be the opening lines of the next chapter in the world's financial architecture. India is the pivotal player here, not just a bridge between two blocks, but the fulcrum of the scale. On one side, the United States. The US is India's biggest client: software exports, pharma, textiles. India's growth engine relies on US demand. American investment also fuels India's startup ecosystem. On the other side, Russia. Russia is critical to India's energy security. Discounted oil and gas narrow India's current account gap and ease inflation pressure. Defense ties still depend heavily on Moscow. Former Ambassador Gautam Bembawale sums it up: "The dragon and the elephant aren't dancing yet, they are just in the same room looking at each other." Yes, Modi's appearance alongside Xi and Putin sends a message to the West, but is not a formal alliance. India is still pursuing a balancing strategy. For investors, the real question is, where does India learn in the medium to long term? Lean toward the US and you'll likely see deeper tech and capital flows. Lean toward Russia and China and you'll likely see lower energy costs, but more friction with Washington. Either path directly reshapes global capital flows. And remember, India's choice affects more than its own growth. It can nudge the global role of the dollar as well. After that scene, Donald Trump didn't hold back. The US is India's biggest client, but they imposed the highest tariffs on us. This is a totally one-sided disaster. Tariffs can sound protective. In economics, though, tariffs often become an extra bill for domestic consumers. Nobel laureate Paul Krugman is blunt: "Tariffs may flatter national pride, but the bills is always paid at home by consumers and taxpayers." Why? Because higher costs either flow through to price or squeeze corporate margins. Either way, consumers pay more or companies shrink. Trump's remarks underscore a long-standing asymmetry in US-India trade. American firms struggle for access to India's market, while India sells billions into the US. For investors, that means short-term, higher volatility; medium-term, companies rethink supply chains; long-term, trade reorganizes around new blocks. Bottom line, this isn't mere political theater. It's a risk that markets will price. Now to the big question, the dollar's future. The US dollar remains the world's reserve currency. Depth of liquidity, safe haven status, and legal infrastructure remain major advantages. But China and Russia are actively pushing to reduce dollar dependency, setting trade in local currencies, gold-linked arrangements, regional payment systems. Economic historian Barry Green cautions, the dollar isn't replaced overnight, but even small shifts can raise US borrowing costs. Consider this, if this 1% of global reserves left the dollar, US Treasury yields could drift higher. That constrains the Fed's policy space and raises financing costs for US corporates down to your own borrowing costs. Economist Kenneth Rogoff adds, dollar dominance doesn't crumble easily, but each sanction and each trade war nudged countries further toward alternatives. The dollar won't abdicate in a day, yet as new doors open around the throne, the ranks of dominance shrink. For investors, that long-run drift matters. You can't discuss global finance without energy. Russia's discounted oil to India and China's long-dated energy contracts aren't just trade. They are financial sovereignty strategies. Macro strategist Zoltan Postar frames it this way. A new Bretton Woods is emerging, this time commodity, anchored and multipolar. If more flows settle in rupees or yuan instead of dollars, aggregate demand for dollars declines. The US response? Sanctions, price caps, and tougher trade barriers. The result? More energy volatility, higher insurance and freight costs. Energy prices aren't just about a barrel of oil. They are also key drivers of FX, rates, and equity indices. So what should investors learn from this? Equities, import-intensive sectors face margin pressure. Energy logistics, fertilizers, and defense could find tailwinds. FX is strong. DXY keeps EM currencies under pressure, but alternative settlement rails could slowly buffer that. Commodities, oil stays highly headline sensitive. A single sanction or tariff headline can spike prices. Bonds, Treasuries remain a short-term safe haven, but gradual erosion of dollar primacy could soften the reflex over time. Dr. Doom, Nouriel Rubini warns, geopolitical fragmentation isn't only political, it creates financial fragility. In other words, headlines may look political, but the impact shows up in cash flows, margins, and balance sheets. In short, that image from Tianjin wasn't just a photo. It was a symbolic signature on a future of global finance. The sharp reactions from Washington show that signature won't be ignored. At Heart of Economy, we'll keep analyzing these developments not as mere events, but through their financial consequences. If this analysis brought you value, subscribe to the channel, like the video, and share your thoughts in the comments. Do you think India will learn toward Washington in the long run, or toward the Beijing-Moscow axis? We are keen to hear your view. See you in the next video.